Welcome to the Opening Bell Report.
Okay, so if you haven't been watching the semiconductor space in, say, the last 24 hours, you have missed a really pivotal move. We need to talk about Micron, ticker symbol MUFU.
We definitely do.
Because something shifted. It wasn't just, the price going up. It was more than that.
There's a change in character, a fundamental change.
Exactly. I mean, we're looking at a stock that is right now sitting at $410.34. It's up nearly 10% in one day. But the thing that really caught my eye, and what we're going to unpack, is that it just blew past the $400 level.
Blew past it.
And that wasn't just a number. It felt like a psychological fortress for anyone betting against it.
It really did. Usually when a stock gets to a big round number like that, an all-time high, it kind of hesitates. It dances around. This didn't hesitate. It kicked the door in.
So the whole premise of our deep dive today is pretty simple, but I think the answer is complex. With Micron at these all-time highs, the first reaction from most investors is probably, well, I missed it.
The train's left the station.
Right, but we've got a specialized breakout report in front of us. It's titled Micron's Ascent, the AI Supercycle to 500. And it argues the complete opposite.
It's arguing that this isn't the end of the move at all. It's actually the confirmation, the start of something new.
Right. So we aren't just looking at, lines on a chart today. We're looking at what might be a fundamental identity crisis for Micron. It's a shift from being this boring cyclical commodity company
into a monopoly-like infrastructure play. And that distinction, commodity versus infrastructure, that is worth billions and billions in market cap.
Okay, let's get into the mechanics of the move first. Part 1. The technical breakout. The report keeps using this phrase, gap and go.
Sure.
I know technical analysis can feel a bit like
reading tea leaves.
Exactly. But in this case, the price action is telling a story. So what specifically happened between yesterday's close and today's open?
Well, it's really a story about urgency. Just look at the raw data. Yesterday, Micron closed at 373.25. A good day. But today, it opened at 395.38.
That's a $20 air pocket.
It's a massive breakaway gap. The price literally skipped over that entire range. The market was willing to pay $20 more per share just to get in at the open. When you see a gap like that on a stock this big, it tells you that the institutions, the hedge funds, the pension funds, they realized overnight that they were just plain wrong.
They were caught offsides.
Completely offsides. And the report really emphasizes this. These kinds of breakaway gaps, they rarely fill immediately. You always hear traders say gaps get filled, meaning the price will drop back down. But a breakaway gap is different. It signals the start of a new, really aggressive trend. It says the demand is just so overwhelming that the big buyers aren't even waiting for a dip.
And who are these buyers? Because, retail traders on Reddit can move a tiny stock, but to move Micron 10%, that takes some heavy artillery.
That is the absolute key. The report notes this all happened on institutional grade volume. This is not meme stock behavior. This is what we call institutional capitulation.
But we usually use capitulation to mean panic selling at the bottom, right?
We do, but this is the other side of it. This is panic buying. Just imagine you're a portfolio manager and you're benchmarked against the semiconductor index. All of a sudden, Micron re-rates overnight. You're underweight. Every minute you don't own it, you're losing to your benchmark. You have no choice. You have to force your way in. That's what a 10% move looks like.
It's FOMO with billions of dollars behind it. So let's talk levels. Before this breakout, the stock was just stuck in the mud around, 370 to 380. That was the ceiling.
That was the resistance zone. It had been rejected there multiple times. But this is where the psychology just completely flips. That old resistance, 370 to 380. The report says it has now become concrete support.
The ceiling becomes the floor.
Precisely. The entire mindset shifts. Last week, a trader's thinking was, if it hits 380, I'm selling to take my profit. Today, because the whole character of the stock has changed, that thought is now, if it dips to 380, I'm buying with both hands. That level is now the safety net for this whole breakout.
Okay, so the chart is screaming buy. The institutions are panic buying. But charts can lie, or at least they can be irrational for a while. We need to understand the fundamental engine, which brings us to part 2, the fundamental shift. The report uses this term, the supercycle. It claims Micron has actually decoupled from the memory cycle.
Which is a huge claim to make.
It's massive, so let's challenge it. For decades, the big knock on Micron has been that it sells a commodity. Memory chips are like corn or oil. When there's a glut, prices crash, Micron bleeds cash. Why is this time any different?
The difference is one acronym, HBM, High Bandwidth Memory. But we need to go a little deeper than just the acronym. We have to understand the actual economics of HBM versus standard DRAM.
Let's unpack that. Because to an outsider, a memory chip is a memory chip.
Not anymore. Think of old school DRAM like selling gasoline at the pump. The price changes every single day based on global supply. It's a spot market. You have zero pricing power.
And that's why Micron's PE ratio has always been in the basement. Investors hate that kind of volatility.
Exactly. But HBM is completely different. It's not a commodity. It's a bespoke, incredibly complex component that is physically integrated into the AI chips themselves. You don't just, buy HBM off the shelf and stick it in an NVIDIA GPU. It's a partnership.
So it's more like a utility pipeline than a gas station.
That's a perfect analogy. And because it's so complex, the supply side is totally different. And this is the stat from the report that just stops you in your tracks. Micron is officially sold out of high bandwidth memory for both 2026 and 2027.
Sold out. I want to push back on that for a second. I mean, sold out sounds great. It sounds certain. But doesn't it also cap their upside? If we're in a super cycle and demand just explodes even more next year, isn't Micron stuck in these fixed price contracts while the market price is going to the moon?
That's a really valid concern in a normal commodity cycle. But in this case, the stability is worth so much more than the potential for a volatile spike. These contracts are fixed at very high margins. We're talking about replacing unpredictable, low-margin revenue with guaranteed high-margin revenue for years to come. That's why the market is re-rating the stock. They're not paying for a lottery ticket anymore. They're paying for a predictable annuity of cash flow.
Okay, that makes sense. It basically de-risks their future earnings. And that brings us to the money shot, part 3, the path to $500.
A math behind the target.
Right, because 500 is a nice big round number, but we're at 410. We still need, what, a 22% move from here? The report talks about multiple expansion. Now, our listeners know what a PE ratio is, but why is the history of Micron's PE so important here?
Because for 20 years, Micron has been trapped in the valuation dungeon. Historically, it trades at a PE of about 10, which is dope cheap. But investors kept it there because they were always terrified of the next cyclical downturn.
They treated it like a mining company or something.
Exactly. But if you accept this new thesis that HBM makes Micron into an AI infrastructure monopoly, well, you don't value a critical utility at 10 times earnings. You value it closer to 20 or 25. That's the re-rating.
So even if they didn't sell a single extra chip, just the market deciding you're a real tech company now, not a commodity company, could double the stock.
In theory, yes. That's what multiple expansion is. But the earnings are growing too. The report models out a bull case for projected EPS earnings per share of $35.
Let's dig into that $35 number. Where does it come from? Is that just selling more volume?
It's really a margin story. This is
Yeah.
crucial. Standard memory, it operates at gross margins of maybe 20–30% on a good day. HBM is what we call accretive. It has significantly higher margins. So as HBM becomes a bigger piece of the pie, it pulls the whole company's average margin up toward 40, even 50%. So that $35 EPS isn't just revenue growth, it's a huge boost in efficiency.
So they're selling a better product that's more profitable.
Exactly. And if you take that $35 EPS and you apply a conservative 15 times multiple, and remember, 15 is still way below that AI premium of 20, you land at a stock price of $525.
So 500 isn't some pie-in-the-sky number based on hype. It's actually based on a pretty conservative multiple of where their earnings power is headed.
That's just math. If they can execute, the price should follow.
Okay, there's one more factor the report brings up, the NVIDIA shadow. They call it a symbiotic relationship.
It's the old pick and shovel argument. You simply cannot build a next-gen NVIDIA cluster, whether it's Blackwell today or the upcoming Rubin architecture, without Micron's HBM. It is physically impossible.
So as long as NVIDIA is selling GPUs?
Micron is selling the memory. They are locked together.
And there's a psychological part to this too, right? A lot of investors feel like they missed the boat on NVIDIA. They think, I can't buy it up here, it's too expensive. So they rotate into Micron as a catch-up trade.
It's the next best thing. Or if you look at the valuation gap, maybe it's the better thing right now.
That's the argument, yeah.
Yeah.
If NVIDIA is the engine, Micron's the fuel. And right now the fuel's on sale compared to the engine.
Exactly.
Okay, I'm seeing the bull case very clearly. But my job is to be the skeptic. This is a deep dive, not a fan club.
Yeah.
So part 4, risks and reality checks.
The voice of reason.
What kills this trade? The report identifies 2 really specific threats. Let's start with the macro one. CapEx cuts.
This is the big one. CapEx is capital expenditures. Right now you have the hyperscalers, Google, Microsoft, Meta, they're in an arms race. They are spending billions and billions on AI data centers. They are the whales buying all these chips.
But trees don't grow to the sky.
They don't. If Mark Zuckerberg or Satya Nadella gets on an earnings call and says, you know what, we might have overbuilt, we're going to pause spending to digest what we have, the party is over immediately.
And it wouldn't matter how great Micron's tech is at that point.
Not at all. If the biggest customers on planet Earth close their wallets, the stock will get crushed. Micron is just leverage to big tech's budget.
Okay, so that's the demand risk. But there's a supply risk too. The report points to yield issues, specifically with HBM4. Why is this stuff so hard to make? Why can't they just crank them out?
This is where the physics gets really tricky. HBM isn't one flat chip. It's a vertical stack of memory dies connected by thousands of tiny microscopic tunnels. You're basically building a skyscraper on a chip.
And if one floor of the skyscraper is busted,
The whole building is condemned. That's the yield problem. If you have one tiny defect in one layer of that stack, you have to throw the entire, very expensive unit in the trash. It is incredibly difficult to do at scale with high yields.
and their main competitor, SK Hynix, has been at this for longer.
That's right. SK Hynix is the leader. Micron is playing catch-up. If Micron's manufacturing yield on HBM4 is even 5% lower than Hynix's, their cost basis explodes. And that whole margin advantage we just talked about, that path to $35 EPS, it vanishes.
So this is an execution story. We are betting that they can manufacture the most complex memory chip in history at scale without messing it up.
It's not a given. It's a very real manufacturing risk that you have to respect.
All right. We know the bull case. We know the risks. Let's get actionable. Part 5. Strategy and key levels. If someone listening is thinking, okay, I get the thesis, but 410 feels a little rich to chase, what does the report suggest?
The advice for a trader is just one word: discipline. Do not chase a massive green candle.
It's hard, though. You see it moving like this. You feel like you have to jump on or you'll miss it.
That's how you get hurt. The report suggests waiting for a flag pattern to form or just a simple pullback. Specifically, look for a dip back into that 400 to 405 range.
You want to see it test that old breakout level and prove that it can hold?
Exactly. You need to see that the ceiling turned into a floor theory is actually true in real time. If it holds 400, that becomes your low-risk entry to ride the momentum up towards 450 and beyond.
We've got a cheat sheet of critical numbers from the report. I want to run through these so everyone has them clear in their head.
Let's do it. First up, $500. That is the target. It's psychological, sure, but it's mainly that 15 times valuation on forward earnings.
Okay. What's standing in the way?
Next is $4.55 and 48 cents. That's the resistance. It's the intraday 52-week high from the breakout day.
So if we close above 455, it's blue skies ahead.
If we clear that level, the report says it triggers the final leg up to 500. There's basically no structural resistance above that number.
Okay. And on the downside,
Okay.
the key levels to watch.
410.34 is where we are, give or take. We need to see it stay above 400 this week to really confirm this breakout has legs. And then, the line in the sand, $380.
That's the floor.
If for some reason it breaks back below 380, the breakout has failed, it was a fake out, and the report is very clear. You exit the trade immediately.
That's so crucial. Don't marry the stock. If it breaks 380, the thesis is broken for now.
Absolutely. Stops keep you in the game.
So let's bring it all home. The summary. The thesis is that yesterday's move, it wasn't just noise. It was the market waking up to the reality of the supercycle. $500 isn't a ceiling. It's a milestone based on the fact that their most profitable product is already sold out for years.
That's the core of it. We're watching a company completely change its stripes in real time.
But I want to leave our listeners with the final provocative thought from the report and maybe challenge it a little. The report closes with this sentence: Micron has officially decoupled from the memory cycle. Welcome to the AI supercycle.
It's a bold declaration.
It is. But here's the question I want you to consider. If memory really is infrastructure, now, if it's as vital as electricity for the AI economy, does the old way of valuing semiconductor cycles just disappear forever? Or is supercycle just a fancy new term we use right before the bubble bursts?
That is the multi-billion-dollar question, isn't it? I mean, history tells us that every time investors say this time is different, it usually isn't. But then again, we've never seen a technological shift quite like AI before.
When you climb higher, the air gets thinner. Keep your eyes on those levels and don't forget the risks.
Don't forget to like, share, and subscribe for more.